A stock doesn't move 14% in one session by accident, and it rarely means what the headline says it means. Rivian Automotive closed today up 13.8% on volume, roughly 3 times its 30-day average, which is not retail enthusiasm. That is institutional repositioning. So the question you have to answer before you touch this trade is whether that capital moved in because something fundamental changed at Rivian, or because the market finally caught up to something it had been ignoring. The answer changes everything about how you think about the next 60 days of price action. Let's start with the mechanics of the move, because context here is everything. Rivian's 13.8% surge in July 2026 came on the back of a combination of factors that stacked on top of each other in a short window, the kind of confluence that produces outsized single-day moves. The primary driver was a production and delivery update that materially beat street expectations. Rivian reported quarterly deliveries that came in significantly above the analyst consensus estimate, signaling that its Normal, Illinois plant and its newer Georgia facility are finally ramping towards something that looks like operational discipline. For a company that spent most of its public life being defined by production misses, a genuine beat on this metric is not incremental news. It's a thesis shift. Layered on top of that delivery beat was a reported update on its commercial van relationship with Amazon. Amazon remains Rivian's anchor customer and holds an order of up to 100,000 electric delivery vehicles. Any signal that this relationship is deepening or accelerating, delivery timelines moves RIVN because it converts theoretical backlog into real, durable revenue. When both a consumer delivery beat and a commercial relationship update land in the same news cycle, you get a multiplier effect on sentiment. Now, here is where you need to stay disciplined. Heavy volume confirms conviction behind a move. It tells you that the price action is not a thin market illusion. But high volume on a surge also means that a significant amount of institutional money has already repriced the stock. You are not getting in front of this news. You are deciding whether to buy the interpretation of it. That is a fundamentally different risk calculation, and beginners conflate the two constantly. The catalyst was real. The question the market is now debating is how durable it is. A 14% single-day move demands a reality check against the underlying business, because markets are not always right. They are fast. So let's audit what Rivian's fundamentals actually look like heading into the second half of 2026. Rivian is not yet consistently profitable at the operating level. That is the foundational fact you cannot ignore. The company has been burning cash since its IPO and has been in a multi-year battle to reach gross profit per vehicle, a metric that sounds basic, but is the entire game for an early-stage automaker. The encouraging news is that Rivian has made measurable progress on cost reduction. Its cost per vehicle has declined substantially from the early production chaos of 2022 and 2023, and management has guided towards sustained positive gross margins. If those gross margin targets are being hit, and this quarter's delivery beat is accompanied by improving unit economics, then the move is not irrational. It is the market updating a probability distribution. Here's the framework that actually matters. Rivian's valuation is still heavily dependent on 2 future states. One, that it can scale production efficiently enough to reach meaningful positive free cash flow before its liquidity position forces another dilutive capital raise. 2, that the Amazon commercial vehicle relationship converts backlog into revenue at a pace that provides a stable revenue floor while the consumer side matures. Both of those conditions becoming more likely in the same quarter justifies significant upside repricing. However, the competitive environment is not forgiving. Ford has its e-Transit, GM is pushing hard on commercial EVs, and the Chinese manufacturers are entering more global markets. Rivian's moat is its software, its adventure-oriented brand identity, and its Amazon partnership, none of which are permanent advantages without continued execution. This is not financial advice, but the intellectual framework here is justified catalyst plus improving fundamentals equals a move with legs, only if the next data point confirms the trend. One quarter is a data point, not a trend. Every outsized single-day move is a classroom, and what you learn depends entirely on the questions you ask. Most beginners ask, should I buy this right now? That is the wrong first question. The right first question is, what does this move tell me about how the market was previously positioned? When a stock moves 14% on a delivery beat, that, while solid, is not a complete fundamental transformation, it means one of two things. Either the market was significantly underpricing the stock before the catalyst, meaning sentiment had gotten too negative relative to operational reality, or a meaningful amount of short interest is being squeezed out of the name, which turbocharges a move that might otherwise be a 4 or 5% day. In Rivian's case, which has historically carried elevated short interest given its cash burn narrative, short covering almost certainly amplified the magnitude. Understanding that mechanics stops you from reading 14% as 14% worth of new fundamental value creation. Some portion of that move is structural repositioning, not valuation revision. The second lesson is about timing frameworks. If you were not positioned before this catalyst, the disciplined question is whether you believe Rivian's next 90 days of data, another delivery report, a gross margin update, any Amazon-related news, will confirm or challenge what today's move implies. Chasing momentum without that answer is speculation dressed as investing. The third lesson, and arguably the most valuable one for anyone building serious capital, is about the difference between narrative stocks and compounder stocks. Rivian is still a narrative stock in 2026, meaning its price is heavily influenced by what investors believe is possible, not just what is currently being delivered. That creates genuine opportunity in both directions. Narrative stocks can be right or wrong by a factor of 2 or 3 over a 12-month period. You need to know which game you are playing and size accordingly. A 3 to 5% position in a high-conviction speculative name is intelligent. A concentrated bet based on one day's price action is how accounts get permanently impaired. So here is where we land. Rivian's 14% move had a real catalyst. Improving fundamentals are beginning to support a higher floor. But the magnitude of the move was amplified by short covering and stacked sentiment, not pure fundamental repricing. The open loop this leaves is this. If Rivian's next quarterly data confirms this trajectory, what does the valuation case actually look like at scale? That is the video we are building next. If you think this way about markets, subscribe. There is more where this came from.